Welcome back. Having learnt dividends and share repurchases, our focus for this lesson is to discuss the considerations in choosing between the two. We'll discuss the effect on shareholder wealth and study the effects if share repurchase is financed through new debt. We'll also discuss the rationales managers have for choosing share repurchase over dividends. Lastly, we end with a short discussion on global trends in corporate payout policies. Let's dive right in. Let's carry on from our example in the last lesson. We've learned that the earnings per share of a company will remain the same after a cash dividend is paid, but will always increase after a share repurchase using cash. In the case of cash dividends, shareholder wealth is directly increased as he receives the cash. In the case of share repurchase, shareholder wealth is indirectly increased as the share he holds is now worth more. Herein lies the question. If there's no difference in tax treatment between dividend and capital gain, which of these methods has a greater impact on shareholder wealth? We can look at this from the perspective of market value per share. Take note that this is not the same as book value per share we discussed in the last lesson. Before distribution, there were 18 million shares, and the market price was $20 per share, so the total market value of the shares is $360 million. In the case of cash dividend, $60 million cash is divided over 18 million shares, so the dividend per share is $3.33. After dividends, the total market value would have dropped by $60 million. Divide this by 18 million outstanding shares, we have market value per share of $16.67. Add on the $3.33 dividend that the shareholder received, the total wealth from the ownership of one share is $20. In the case of share repurchase using cash, 3 million shares were repurchased, so the number of outstanding shares drops to 15 million. Likewise, we deduct the $60 million cash from the total market value, so the total market value is reduced to $300 million. However, since there are fewer outstanding shares, the market value per share after repurchase works out to $20. In this case, even though the shareholder did not receive any cash, his wealth from the ownership of one share is the same as the case if he received dividends in cash. This example demonstrates that, assuming the tax treatment of the two alternatives is the same, a share repurchase has the same impact on shareholder wealth as a cash dividend payment of an equal amount. However, we have to qualify that this only applies if the shares are repurchased at their market price. As we know, companies sometimes pay a premium to repurchase their shares. Now, let's rework this using $30 per repurchased share. See if you can work out the market value per share in this case. Pause the video now and work out your answer. And we're back. The difference here is that as the cost of each share has increased to $30, so the number of shares repurchased is lower, and the number of outstanding shares is now higher at 16 million. Market value after deducting the $60 million cash is $300 million. Divide this by the outstanding number of shares, we get $18.75 market value per share. So in this case, since the company repurchased shares at a price higher than the market price, the resulting MVPS after the share repurchase is lower. In this case, the shareholder wealth is worse off than if he had been issued with a cash dividend. From this example, we learnt that one important consideration when deciding between cash dividend or share buyback is the repurchase price. If the price is too high above its market value, shareholders may be better off receiving the cash dividends. You should also note that in the case of repurchase at a premium, the market price may increase as investors may view this positively, so shareholders' wealth increases. However, this effect is hard to quantify and outside the scope of the curriculum. Another thing you need to be aware of is that instead of using cash, some companies issue debt to fund its share repurchases. If the entire repurchase amount is funded using additional debt, the total assets should remain the same, just that the company has swapped equity for debt. Obviously, the leverage ratio increases in this case. Recall from the last lesson, we learned that EPS will always increase if the share repurchase was done using the company's cash reserves. This, however, does not apply if the company funds all or part of the repurchase by taking on additional debt. So, for our example, let's say the company funds the $60 million repurchase cost with new debt issued at 4% after-tax cost of borrowing. The additional interest cost would be $2.4 million each year. This means the earnings will be lower by $2.4 million. Assuming the shares are bought back at market price of $20 per share, the number of outstanding shares will be 15 million. As such, the EPS after share repurchase in this case would be $1.04. Now's your turn to practice. Let's say the new debt is issued at 6% after tax cost of borrowing instead. What would the EPS be after the share repurchase? Pause the video now and work out your answer. And we're back. In this case, the additional interest cost per year would be $3.6 million, which means earnings would be reduced to $14.4 million. The number of outstanding shares would be 15 million, so the EPS after repurchase would be 96 cents. And you would have noticed this is one example of EPS ending up lower than it was before the share repurchase. There is one yardstick that'll let us know if the EPS after repurchase would be higher or lower than before. We can tell by comparing the after-tax cost of new debt to the earnings yield of the company. The earnings yield is the earnings over the market value of the company. Since the EPS before buyback was $1 and the market price of the shares was $20, the earnings yield before the buyback was 5%. If the after-tax cost of debt is lower than this, the EPS will increase after the buyback. Like for earlier, we calculated the EPS to be $1.04 if the cost of debt is 4%. Conversely, the EPS will decrease after the buyback if the cost of debt is greater than the earnings yield, like what we have here. So the consideration when deciding if share repurchase using additional debt is beneficial is to study the after-tax cost of debt. If it is higher than the current earnings yield, the EPS will be worse, and the shareholders' wealth may suffer. That said, there are other factors that company managers look at when deciding on share repurchase. The CFA Institute lists 5 common rationales for choosing share repurchase versus dividends. Firstly, the potential tax advantages. When the tax rate on capital gains is lower than the tax rate on dividend income, share repurchases have a tax advantage over cash dividends. Secondly, to support the share price or to signal to the market. Share repurchases can signal to the market that the management thinks its own stock is undervalued, so it is a good investment. As we've learned before, signaling is important in the presence of asymmetric information, where the managers have access to better information about the company's prospects than outside investors. This tactic is often used when a share price is declining and management wants to convey confidence in the company's future to investors. Third, added flexibility in earnings distributions. Many companies declare a conservative regular cash dividend that they're confident of paying out over the long term, and periodically repurchase shares as a supplement to the dividend when there is excess cash. Unlike dividends, share repurchases are not a long-term commitment. So effectively, this combination enables managers to have a flexible dividend policy that allows them to vary distributions based on cash flow without the negative impact that fluctuating cash dividends may have on the share price. Additionally, managers have discretion with respect to market timing their repurchases. Fourth, repurchases can offset the dilution from employee stock options. When employees exercise their stock options, existing outstanding shares in the market get diluted. By repurchasing shares from the open market, the dilution effect is reversed. And lastly, share repurchases that are funded by new debt increases financial leverage. This may be a deliberate move by the management to shift the company's current capital structure towards its target capital structure. Dividend policy has been seen to have differences across countries and over time. This is probably to accommodate differences in investor preferences globally, as well as changing investor preferences over time. There have been several studies on this topic, and we summarize the key findings with respect to global trends in corporate payout policies. In developed countries, the proportion of companies paying cash dividends has been in long-term decline. In particular, a significantly lower proportion of US companies pay dividends compared to their European counterparts. However, some studies show that for companies that pay dividends, payout ratios have generally increased over time. At the same time, the percentage of companies making stock repurchases has been trending upwards since the 1980s, and in Europe since the 1990s. And that concludes this lesson on the considerations in choosing dividends versus share repurchase. In our next lesson, we wrap up this topic with a discussion on dividend safety and how to identify companies that may not be able to sustain their cash dividend.